And well, coming up on World Business Watch today, we tell you the biggest events that will shape markets in the week to follow. But more importantly, we will tell you how those events will impact your money. So stay tuned for that special report. Now, but before that, let's take a look at all the market action in the week gone by. A hotter than expected U.S. jobs report rattled Wall Street on Friday, quashing hopes for further Federal Reserve rate cuts. The Dow Jones Industrial Average dropped 1.63%, the S&P 500 lost 1.54%, and the Nasdaq composite fell 1.63%. Growth stocks like Nvidia and AMD led to the losses as Treasury yields spiked, signaling concerns over future rate stability. The week ended in the red for all three indices, with the S&P 500 down 1.9% and Nasdaq sliding 2.3%. Asian equities mirrored Wall Street's gloom, with Japan's Nikkei 225 falling per 1% for its third straight losing session. In China, the CSI 300 dipped 1.25%, its lowest since September 2024, while Hong Kong's Hang Seng shed 0.95%. South Korea's Kospi broke its 5-day winning streak, slipping 0.24%. Weak household spending in Japan and restrained activity in China added to regional market jitters. Oil prices soared after U.S. sanctions targeted Russia's energy sector. Brent crude jumped 3.69% to $79.76 per barrel, while U.S. crude climbed 3.58% to $76.57. Sanctions on Russian oil tankers and executives heightened supply concerns, pushing benchmarks to their highest levels since October. Gold rebounded 0.5% to $2,688 per ounce, gaining over 1% for the week. Strong U.S. job data initially weighed on bullion, but inflation concerns and geopolitical uncertainty surrounding upcoming U.S. policies underpin its safe haven appeal. The dollar index advanced for a sixth consecutive week, driven by robust jobs data and rising inflation expectations. The euro fell 0.5% to $1.0244, while the yen fluctuated amid Japan's inflationary pressures. In the following week, watch for U.S. inflation data, central bank meetings in Japan and the Eurozone, and geopolitical developments as key market drivers. And of course, to discuss more on the story, we are being joined by Andrew Holland. He is the CEO of Avendus Capital Public Markets. He's joining us from Mumbai today. Thank you so much for joining us.
Good morning, and thank you for the opportunity.
Now, let me begin by asking you, stronger than expected jobs reports suggest the Federal Reserve may pause rate cuts or even maintain current rates longer than expected. According to you, how should investors position their portfolios in this environment, especially with growth stocks under pressure?
Yeah, I mean, in the last Federal Reserve meeting, the chairman was very hawkish. And I think the hidden message was that he was worried about maybe some of those Trump policies, which are being widely talked about, could be inflationary, for the best part of the first half of the year. So therefore, with this very hot jobs kind of data that came out, the market, which was baking in maybe 50 basis points of rate cuts, is now thinking possibly there won't be any at all next year. And in that respect, the market was not anticipating that. So higher rates for longer would have an impact on earnings. And that's one of the things that the market has not baked in. What the market has baked in is to say, okay, President-elect Trump will come in, there'll be tax cuts, that's good for earnings. But on the basis that you still have this kind of interest rates being lowered throughout all of 2025. And that at the moment doesn't look to be the case. So that's not good news for equities. And if you look at the U.S. bond yield at 4.7%, it's attractive enough to move investors away from equities into more safe haven bond markets where you're earning 5% with minimal risk.
Right. And that being said, with the U.S. and Asia Pacific markets facing headwinds from rising rates and regional economic data, what sectors or geographies offer the most resilience or growth potential in the near term?
See, I think, I can give you some countries which would benefit, but I think until we see President-elect Trump actually come into office or take over the administration, and what some of those policies might be, it's going to be tough to say, this country will do well. I mean, you could look at safe havens and say, okay, Europe probably won't be as badly hit with tariffs and maybe, China. So relatively, it should be better off. But I'm not sure it's all going to work out that way. So I think, just sitting on your hands, waiting for some of these policy announcements to come through is probably, a kind of good strategy at the moment, of just keeping your cash dry and waiting to see where it's going to fall out. But I mean, sectors which are always going to do well, whether the economy is kind of slowing or not, would be, defense sectors, renewable energy, where that there's going to be a future investment in these areas. So that's one, the two sectors which I would say will stand out at the moment. But I just want to give you one example, is that it's widely kind of viewed that China tariffs could be as high as 50%, and then what would happen after that. But let's just say the tariffs are more like 20 to 30%, then that would be good for news for emerging markets. And if China was to do a stimulus, then that would obviously kind of have the money flows coming towards China, and India would be a beneficiary of that because of weightages in the indices. But then you could say, okay, China's going to start picking up in terms of its economy. And that's going to be beneficial for the likes of, say, Taiwan or South Korea in particular, as they're big exporters to China. So there's a lot of moving parts out there, and I think just waiting on the sidelines to see how they play out is probably a good strategy.
Mm-hmm. Now, the dollar is on a strong upward trajectory, putting pressure on other currencies like the euro and yen, which we talked about in the report. How do you think this prolonged dollar strength impact U.S. corporate earnings and global investment strategies, particularly for multinational companies?
So if I look at, say, the UK market, a lot of those companies, beneficiaries of that because they have dollar earnings. So a weakening currency, when you have a lot of earnings which are offshore, which the British pound is falling, is good news. So, but for the US, obviously, it's going to continue to attract money. So the growth is going to be seen in the US. So again, it's back to, I don't think a strong dollar is going to be good for emerging markets in the very short term, as well as commodities. But those policies will have an impact on how we see both interest rates going forward, currencies, and commodity prices. So again, just waiting for another week or so is probably a more safer haven in terms of not taking any big bets at this point of time. But I think a stronger dollar does this for emerging markets, and particularly in India. We'll talk about the RBI in February. They do have the opportunity to to reduce rates. The question is, will they? They should. But if the currency is depreciating, that will accelerate that depreciation. So that's not good. One, for foreign investors coming into India, because they lose on the depreciation of the currency. But two, obviously, you're going to start importing inflation with a weaker currency as well. So all of these factors, I think, central banks across Asia will be thinking about, and probably just holding the interest rate cycles at the moment. So it's not good news.
Right. Of course. Well, that's all the time we have with you, Mr. Andrew Holland. Thank you so much for joining us and giving your perspective on story.